You've handed us a fascinating deep dive today. And this isn't just, a basic stock report.
Not at all.
It's a full market snapshot from January 13, 2026. It gives us an almost surgical look at where the money is going right now.
It does, and the sources boil down the market psychology into this one brilliant phrase: defense plus thematic optimization.
Right.
And our job is to get past the data points and really figure out why. Why is that specific, almost contradictory strategy dominating everything?
Exactly. We need to pull out the critical drivers.
Yeah.
And the situation is, well, it's tough. The report says we're operating under mid to high interest rates.
And layered on top of that, you have significant political and geopolitical uncertainty.
It feels like the market has two totally different playbooks running at the same time, pulling capital in opposite directions.
That's the core tension. That dual pressure is everything. You've got institutions rushing for the safest ground possible. I mean, true risk-off assets.
At the same time.
At the exact same moment, they are piling into these hyper-specific growth themes they think are, immune to the macro gravity. It's a market that is both strong and terrified.
Let's start with that gravity then, the interest rate environment. The material we have highlights the 10-year U.S. Treasury just refusing to budge.
Yeah.
It's stuck around 4.17 to 4.20%.
And the immediate implication of that is just continuous, sustained valuation pressure.
So what does that mean in practical terms for the listener?
It means the financial air is thin. When you can get a reliable 4.2% return with basically no risk, every high-flying tech company's valuation has to justify that risk premium, and then some.
So every future dollar of profit gets discounted more severely.
Exactly. It just kills off the broad speculation we saw a few years back and forces capital to only chase growth that feels, I guess, absolutely guaranteed.
Okay, so high rates are the foundation. Now let's add the latest real-world data to that. The U.S. December 2025 non-farm jobs report just came out.
And it showed a clear slowdown.
Yeah, only about 50,000 new jobs, and the unemployment rate ticked up to 4.4%.
But what's really crucial here is how the market is reading that slowdown. 50,000 is definitely a deceleration, but the report stresses that employment is not collapsing.
It's slowing down.
It's slowing just enough to maybe ease some wage inflation, which the Fed wants, but not so much that it's screaming recession is here.
And that subtle difference is key, isn't it? A terrible jobs report would force the Fed's hand to cut rates immediately.
Right. But this one, by showing moderation but not a collapse, it lets the Fed keep that pressure on.
It keeps them cautious.
Precisely. It maintains that whole sticky inflation narrative. The market believes the Fed still has the option and maybe even the intention to take its time. The high rates aren't going anywhere just yet.
Speaking of the system structure, let's talk about the technical plumbing. The sources bring up short-term liquidity, specifically seasonal sensitivity around the year-end RRP and SRF. Now, for the listener who isn't tracking money market mechanics every day, why are these arcane acronyms, reverse repo and standing repo facility, still being talked about as the volatility triggers?
That's a great question. The easiest way to think of the RRP and SRF is as sophisticated plumbing tools the Fed uses.
Okay.
They manage the huge amount of cash just sloshing around the system. RRP drains excess cash. SRF is where banks can get emergency cash.
So when people are watching them so closely.
When people track the seasonal shifts in their usage, especially around year-end, they're basically looking for signs of stress or excess liquidity, any little jitters in the system's cash flow.
So it's like a barometer for anxiety.
It really is. The fact that the market is so focused on these subtle shifts just shows how sensitive, maybe even fragile, the short-term system feels right now.
And if all that wasn't enough, we have to talk about the geopolitical layer. The report specifically mentions the ongoing investigation into Fed Chair Powell.
And this is a major risk amplifier. Any investigation, regardless of the outcome, it directly raises concerns over the Fed's independence in the long run.
Which the market relies on.
The market absolutely needs the Fed to be an impartial arbiter. So any uncertainty about its political resilience, it's not just a domestic issue, it immediately turns into a systemic risk premium.
Driving demand for
true safe havens and alternative assets. It changes the entire conversation from what will the Fed do to how reliable is the US dollar itself.
That sets us up perfectly for the central paradox here, the bifurcated market. We've just laid out all the reasons for defense, yet money is pouring into high-risk areas.
And the paradox is right there in the data. US stocks are setting new closing highs, but these gains are on thinly traded volume.
Thinly traded, what does that signal?
It signals fragility. It means these high prices are built on low volume, low conviction. If one big seller shows up or some bad news hits,
The drop is amplified because there's no one there to buy.
there are no buyers waiting to absorb the shock. Exactly.
So let's talk about where the conviction is. The growth side, AI and tech. NVIDIA, the report, calls it the absolute core infrastructure asset of this whole theme.
It is the linchpin. I mean, NVDA isn't really seen as just a stock anymore. It's treated like the essential commodity for the future. It's the oil or the steel of the AI revolution.
A capital hotspot.
The primary one. Its performance is tied not just to its own earnings, but to the entire supply chain of the AI build-out. The market sees it as a utility for future growth.
And what about the other big names? Meta and GOG are also flying.
Yes, but their drivers are a little different. They're huge investors in AI, of course, but their immediate performance is also tied to the rebound in digital advertising.
So they're betting AI will unlock new ad revenue.
That's the bet, and that keeps them in that thematic optimization category right alongside NVIDIA.
Okay, so now let's swing to the complete other side of this paradox. Safety. Gold has just surged, peaking recently between $4,563 and $4,600 an ounce.
An astonishing range, a historic high.
And you mentioned it's being driven by two different forces.
This is where you can really see the depth of the market's anxiety. It's a dual driver phenomenon. The first driver is just your standard short-term risk-off buying.
People running to safety because of the Powell investigation, geopolitics.
The classic safe haven move, that's part of it.
But what's the second driver? What does the report say is pushing it all the way to $4,600?
That's the deeper structural concern. Currency devaluation worries. This suggests that big institutional buyers are positioning not just for a short-term wobble,
But for a long-term problem.
a long-term erosion in the purchasing power of fiat currencies, mainly the dollar. That $4,600 price point is telling you that the big money sees a fundamental instability in the entire reserve currency system.
Wow. Okay, shifting to the other major alternative asset, crypto. Gold is hitting these highs on systemic worry, but Bitcoin, BTC, is sort of consolidating, trading around $90,000 to $92,000.
That consolidation reflects a more cautious institutional engagement.
So it's not about retail sentiment anymore.
Less so right now. The critical indicators for Bitcoin are the official regulated capital flows from the spot ETFs and then the activity in the options market.
So sentiment has recovered from extreme fear, but it's not euphoric.
Not at all. It's decidedly cautious. The market is relying on those regulated capital injections to hold this altitude. The institutional on-ramp is the engine, but it's running at a steady cruise, not a sprint.
So we have this landscape. High rates, political risk, gold soaring on currency fears, and NVDA soaring as the one guaranteed growth theme. Given all that, what is the core strategy recommended in the snapshot?
The core defense is actually diversification in the main indices. VOO, the S&P 500 ETF, and QQQM, the NASDAQ Q100 ETF, are listed as the primary defensive positions.
Because they minimize single stock risk in this thin volume environment we talked about.
Exactly. Then for the AI leaders, NVDA, GOG, Meta, the advice is staggered buying, dollar cost averaging, buying the dips instead of chasing the peaks. You get in on the theme, but you manage your entry risk.
But there's always a section for the high-octane speculative bets. The source details a few high-volatility assets. Solana, or SOL, as mentioned, trading wildly between $130 and $140.
SOL is still that definitive high-beta bet on the layer 1 crypto story. It shows there's still an appetite for extreme growth, if you can stomach the volatility. But then the report details some even riskier assets.
Which carry a significant warning.
A huge warning. We're talking about things like hyperliquid, HYPE, and the pre-stocks. Those are private shares of companies like Anthropic, XAI, OpenAI.
And what's the fundamental warning there?
They're categorized as ultra-high-risk speculative assets, suitable only for tiny allocations. And the warning isn't just about the company risk, it's about the market structure risk.
Meaning?
These assets have massive, quote, discrepancies and almost no liquidity. So you might see a high price listed, but if you try to sell any real size, the price could just collapse because there's no depth.
So you need clear exit rules.
You need explicit set exit rules. This isn't the same as playing in liquid stocks or major crypto.
Which brings it all back to the need for active management. You can't just set it and forget it here.
Active management is absolutely critical. The report basically mandates using gold or gold ETFs for that systemic risk hedging we talked about. And for crypto, the rules are strict. Small incremental entries and rigid stop losses.
And keep an eye on the institutional flows.
You have to track those ETF flows. They are the main short-term barometer that's overriding everything else right now.
Okay, let's wrap this up. What does this deep dive ultimately tell us about the market mood on January 13th, 2026?
It tells us capital is in a squeeze. It's trapped between the heavy weight of high interest rates, which limits broad gains, and the immediate acute pressure from political risk, which demands safety.
And that toxic combination forces this dual strategy.
It forces it. Defense first, broad ETFs, and, critically, gold mixed with highly selective aggressive betting on what's seen as the only sure thing. AI infrastructure, which really just means NVDA.
So we know the forces.
Yeah.
What are the immediate catalysts you'll be watching next week that could shift this delicate balance?
The direction next week really depends on two things. First, funds flows. You have to watch the ETF and options data for any signs of institutional conviction changing.
And second?
Second is the big macro data, the upcoming CPI and PCE inflation reports, and the next round of job numbers. They'll either confirm this sticky inflation story or maybe, just maybe, suggest the economy is finally weakening enough to force a rate cut.
And here's where it gets really interesting, and a final thought for you to take with you. Since the report ties gold's historic high to both that immediate safe haven demand and the deep long-term currency devaluation worries, which of those two drivers is going to be more sensitive to next week's inflation data? If inflation comes in hot, does the devaluation worry get worse and push gold even higher? Or does the fear of more rate hikes win out and cause a sell-off?
That tension
safe haven versus interest rate sensitivity is what dictates the next move for the world's oldest safe asset.
A fantastic pivot point to analyze. Stay safe, stay optimized, and thanks for joining us on this deep dive.